Hey folks, Dan Frio here live talking about Housing Bubble 2.0. So I'm having special guest Randy Patrick join us. He's having a little bit of technical difficulty right now. But the preference to this video is most of the questions that I have from viewers, and mostly you guys out there that are potential home buyers, is this: why would I buy now knowing that the market's going to crash? So I don't pump FOMO like I tell you guys every day. So I have viewers on here or realtors on here on a weekly basis telling us about their markets, what they see, and so forth. So the reason why I reached out to Randy Patrick, he has a YouTube channel. So not only is he an influencer, but he's a realtor. So his YouTube channel is Housing Bubble 2.0. So that's what we're working on today. So it's a perfect timing to bring him on today. And he's having a little bit of technical difficulty, but let's preface it with this because everybody thinks that the housing bubble is here. And that's what Randy's here to talk about. I want the facts to be presented to you guys, but the facts that we have today is this, and this is new numbers that are out today. So this is just kind of the headlines. Consumer confidence just came in terrible. And I knew it was going to come in terrible. Why? Well, gas prices alone make me sick. You go to the grocery store, you can't get out of there without a $200 or $300 bill. My utility user bills are going skyrocketing. Finally, gas in Chicago is down from $6 a gallon. You have healthcare. I just got our healthcare bill for all my employees, and they're expecting healthcare to go up 40%. When's the end to all this? So not only on top of that, you have home sales, which just reported today that were dismal. They were down. Those are new home sales. So I want to put a lot of this into context for you. The next piece of the puzzle is foreclosures. You're good. I can't believe you haven't seen this yet, but there was a report just posted saying foreclosures from last year at this time to this year at this time is up 400%. 400%. Can you believe it? So those are a lot of the things that we're going to talk about. Also, because of the housing bubble or the information on that is mortgage rates doubled this year. So back from December, where we were in December to where we were in June, they doubled. Now, coming off of June, we have mortgage rates down 0.75%. So what's that telling us? Well, some news out that's coming out Thursday is we'll find out if we are truly in a recession. So what happens? What is a recession? Well, basically a recession is this: 2 quarters of negative GDP in the United States. Well, quarter one, we have negative 1.9. Quarter two, I'm saying we're going to be at about a -1. Some analysts have us up as a positive half. So where that number is going to be, I don't know. So the next thing is we know the Federal Reserve is doing things. They're going to do something tomorrow. We'll have a live event for that. To basically, I'm going to bring you guys in on the tail end of when the Federal Reserve comes out and tells us exactly what they're going to do. I gave you my roadmap in today's earlier video, and that's why I'm trying to have Randy Patrick on here. It looks like he's having technical difficulty on his end. So why don't we do this? I want your feedback in why you think there's a housing bubble, or why do you think there's a crash imminent? And I'm just going to listen, and I want the feedback. But if you guys would, give us some context, give us some valid information, other than, the point that a lot of people make is, well, the market's so hot, it's so high, it has to come down. Well, that's not a good reason. I guess it could be. But I'd like a little bit more context in all this. So as soon as Randy gets his electronics figured out, we'll get to him. But again, I want your feedback on the housing bubble. I'll give you some of my facts and data, but you guys, if you would, give us some of the facts and data that you have. So start posting your comments if you're here for the Housing Bubble 2.0. I'm having Randy Patrick join us. He's having a little bit of technical difficulty right now, but let's open up the floodgates right now to answer any questions that you guys have. If you would, the first thing I ask you to do, let me know where you're coming from. Where are you watching me from? I've been pushing this out throughout the day to have more people be able to join us. And that's what my goal here is, that the more people we have in here, we need interaction. It's a format here that I'm here to answer questions, listen to you guys. And you guys, maybe we'll do one of those things, change my mind. I don't think there's a housing bubble, but how about you change my mind? We debate this and see where this takes us. So let's get over to the first question. But if you guys would, please let me know where you're coming from and post any comments that you have. So the first question we have, I got to put on my old man glasses, is where do you see mortgage rates heading by Q1, Q2 of 2023? I'm waiting on housing to be built late Q1. My lender's telling me don't lock for 120 days because I'm going to have to agree with your lender there. So here's the context in a lot of this stuff. So I focus on mortgage rates, mortgage programs. I'm revamping my show. I want to get out of the FOMO of real estate because there's so many people out there with so much data, and you can pick and choose the data that you want. Okay. But what I want you guys to understand is if at some point you think, okay, home ownership's for me, or maybe you want to get in investment properties. Is it a good time for investments? You see Blackstone, they're accumulating $50 billion in money, $50 billion in money to try to start buying up the housing market. So because you have that much built into the system, you know that much money's coming into the housing system. That's another reason why I keep saying, why is it going to crash? But let me get to the question. Where do I think rates are going to be? Well, probably on Thursday, we're going to find out that we're in a recession. Okay, what does that mean? Well, in most cases, a recession, in the past 6 that we've had, they did not come with a dramatic drop in home values. That's probably surprising to a lot of people because you're going to say, well, all the other videos I watch says, as soon as a recession hits, everything just falls off a cliff. So that's the one piece of the puzzle that I want to talk about. But let me get to your exact question. When a recession hits, normally what happens is you'll see interest rates, especially mortgages, drop about 1 full percent. Okay. Well, let's put some of this into context. Let me see if Randy is able to join us yet. Randy, we still have no video. Okay. So let me put this in the context. In the last 4 weeks, we've seen interest rates drop 0.75%. Okay. Is that telling us something? All right. So while these rates were running, I thought the same thing as you guys. When is this stuff going to end? And I don't know. But let me answer your question, then I'll bring Randy in. He just got all his technology fixed. So I'm thinking rates right now are going to be stagnant. Okay. There's really nothing in the markets that's doing anything other than the Fed. The Fed's going to come out tomorrow, like I just said in my earlier video. They're going to raise rates 75 basis points. Then from there, what's the future guidance that we're going to have? So my channel focuses on that on a daily basis. In the morning, we talk about rates. Then in the evening, I try to explain to you, or in my other videos, all about housing and the financing piece of this puzzle. Okay. So in the question that you have from their lender, I would be the same way. I don't think rates are really going to go anywhere. They'll be stagnant from here. They may go up a little bit and then come back down a little bit. I would wait to actually start looking at mortgage rates about 180 days out. Once you get 90 days out, it opens up the floodgates of all these opportunities for you. But I don't really think rates are going to completely get out of whack in the next 6-8 months or 12 months because a recession's on the horizon. So that being said, we got Randy. So Randy, let's bring him on. He is the founder of Housing 2.0. He's also a realtor. So I reached out to Randy to say, Randy, love your channel, love your content. I just want to know your thoughts behind the housing market and why you think it's a housing bubble. And then what's your prediction on what do you think the housing market is going to do within the next maybe 6 to 12 months? So welcome, Randy. Can you hear me?
Dan, how you doing? Sorry about that.
No worries, man. This technical difficulty. I had last week's video. I went on and all my staff came in. So they're like, dude, you're not on YouTube. So we are at least on YouTube and I'm glad to have you, man. And like we said in the previous, there's no gotcha moments. I'm just out here to discuss what your thoughts are. We know you're the founder of Housing 2.0. I just want how you come up with that thought. And then kind of talk us through what your thoughts and what you're seeing out in the market right now. But again, thanks for joining me, man.
Hey, appreciate it. And thank you for having me on. It's a great honor. I love doing stuff like this. And again, yeah, technology gets you sometimes. I don't know what happened, but my other computer couldn't recognize the software. So this one does.
Look at all our gray. We don't get some of this stuff.
I know. What I mean? If I had less time doing tech and more time do other business, I'd be
seriously
well ahead of the game. Yeah.
So welcome. So how'd you come up with Housing 2.0?
Well, I've actually been, I guess you could say, pontificating about this for the past while. And to be quite honest with you, I did a lot of participation in the last housing crisis. So back in really 2007, when everything was kind of falling apart, we were on, the forefront of what I would call the short sale market. And I live down here in the Tampa, Florida area. And, Florida, as you know, got hit pretty hard. like other locations across the country with respect to the housing crisis. And we were, so it's kind of like housing bubble, was happening, literally, connecting with real estate agents, trying to purchase properties, and, getting a lot of pushback with respect to, there's no bubble here. Everything is, this is just a blip or a dip in the marketplace. It's going to come back. And then you had the likes of Alan Greenspan and Ben Bernanke at the Fed saying, "Oh, it's some markets are frothy," right?
Yeah, I remember that.
That I have that video saved. I love that video. Yeah, some markets are a little over exuberant, showing some froth, but everything is okay. Nothing to worry about. Well, then look what happened. And it crashed. So, that took us, I think, all by surprise. And, I guess you could say you basically baptism by fire. You learned what was going on. You tried to pivot and try to do what you can. As I said, we were big in the short sale market. So, even though I'm a licensed real estate broker here in Florida, we primarily did our business as buyers, as real estate investors back in the day. So we were connecting with the real estate agents that had listings, and we were offering them, we actually were offering them literally 47% of list price. And they were kicking back going, "What's wrong with you guys? You're crazy. That's insulting." We were, getting, we had a lot of problems because we actually had a fax server that was sending out offers that were, 47% in the dollar, and we got a lot of flack for that. But, guess what happened after, about a year? The majority of the listings that were on the MLS were short sales. And then, off to the races. So, I got to learn and figure stuff out. That's why, now that we're in housing bubble 2.0, we're right here. And if you really start peeling back the layers as to what's happening in the marketplace, and I call them like the signs, virtually identical to the previous housing crisis. And, even today, I know I was going to mention that you're right. You saw that 440% foreclosure start year over year increase, right? So you can't deny stuff like that. Interest rates are probably going to rise again by the end of the week. And then, more buyers are going to be out of the marketplace. Sellers are going to have to adjust. Inventories, picking up now. Price points are coming down. So we're really in this, like, we've passed the peak. We've really sort of gone over the peak, and we're on the other side now. And literally, I read an article today. It's an economist, and he's saying, perfect storm is on the way. We're just like 2008. And, one of the things that people like, this is always the pushback. So of course, I can talk about why we're going to have why we have a housing bubble. Then there's those that say, there's none. Typically, the housing bubble commentation is, well, you've got, exuberance in the marketplace. So people are buying, etc. You've got loose lending standards, you know what I mean? And you have speculation. So that's typically sort of what made the previous housing bubble. And that's sort of the housing fundamentals that people want to stick to. Well, where are we today? Have we had a couple of years of ridiculous home price appreciation? Sure, we've had a ton of that. We've had double digits for the past couple of years. And locations, when you have like Phoenix, 30 some odd months of over 30% year over year appreciation on Case-Shiller. Now Tampa is leading where I am. Tampa is leading the charge now. It's having the past couple of months on Case-Shiller, home price index over 30% year over year. So we have that. Right. Do we have inventory issues? Well, we used to, but inventory is coming back now. As you said, you mentioned it earlier that, the home price, not the new home issues, right? New home builders are taking the heat now. They've got over 9 months worth of supply. So, the people aren't buying, they're having to drop prices. So we're having some inventory coming back. And then with respect to the biggest thing is speculation. And that, to me, that's the number one thing out there, is that, investors speculate. So investors create housing bubbles. Well, what have we heard for the past, say, 2 to 3 years from primarily Redfin, right? We all know who Redfin is, that sort of an iBroker type thing. Well, they like to talk about how many, we'll call it competitive offers or bidding wars, that their listings are in. Well, we know that, there was, you've heard it, I've heard as well too. People are bidding, $50,000, $100,000 over list price. So, I don't know why, but some of the housing, sort of analysts seem to reserve speculation for the investor community. Well, that's I think we've blown that cover right now, because when you're out there and you're bidding $50K over list price on a property, are you not, as a retail buyer, speculating that your appraisal is going to catch up with your purchase price, that
Good
you
point.
hope
Yeah.
the market's going to continue to rise. So now you're not underwater, that you're riding the wave of appreciation. So for me, when you really start, looking at you know, the issues, they're all here again. And it's not, and I want to be clear, it's not one issue that pushes us over the edge. It typically is a number of issues, usually simultaneously or happening in succession, that just, it creates so much pressure the market can't bear it. And then it all breaks loose. So we're kind of at that point right now. I think we've actually, now that the summer selling season's kind of over, we've actually passed the peak. We're starting to see the slide now.
Yeah. Got it. So I'm just going to throw some questions at you, because I'm, as you know, we had a conversation prior to, I'm a little bit on the other side of the fence, but I love dialogue because I want to learn. You have your foot in basically your boots on the ground. You're seeing this face by face. I'm sitting here in my glass house. We're doing applications. So I just see the mortgage flow of business. There's no refinances left. Nobody's refinancing.
Yep.
And the purchase market's really dropped off. We had 5 cancellations on people building houses, I think Friday alone. So for us, it's devastating, because I'm a small business. I'm a really small business. Last year we did 80 million in volume. There's 5 or 6 of us. So, this year is a little bit different, but I'm going to throw some ideas out at you, or some kind of counters to you, and just let me know your thoughts on this, because one of the biggest things I feel that the 2008, and I agree, I saw a lot of this coming. I've been in the mortgage business for 33 years. So I've been through the good, the bad, the ugly, and the absolutely terrible. But in 2008, my biggest, I guess, my thought on why that bubble bursted as big as it did is because of the subprime market. So you probably hear this all the time. It's my side of the equation's come back to say, okay, it was bad underwriting, at that point, and that was what caused a lot of this. And not only was it that, it was also the Ninas and the no income docs. It was, the comment is if you had a pulse, you can close on a loan. So those, I saw it. I was part of that industry at that point, and I saw it coming, because you had a lot of these teaser rates, interest only, bad underwriting products that actually came to fruition back in like 2006 to 8, when all these adjustable rates started going up. The teaser rates would go away, the interest only would go away, and your payments would go up double, in some cases triple. So that's what fueled this fire. So what would be your say on that piece of it? Because I'm in business now, and it is as hard as it's ever been to get mortgages. So the underwriting standard that I think was what created the last kind of crash is we were missing in this equation. But what are you seeing on your end?
Well, if we go back in time to the last housing crisis, subprime mortgages, the mortgage meltdown kicked off the housing crisis back then. But realize that out of all the mortgages that went under, we had 10 million or so foreclosures. Only about 20% really you could categorize as subprime. The rest were conventional, or some of these other mortgages, as you mentioned. But really, the issue was that started the process. But a lot of the problems were cash out refis. So people were just pulling money out. They were running the appreciation. They're pulling money out. And therefore, they weren't using, a refi, to help improve the property, et cetera. They were buying fun stuff, cars, boats, whatever, vacations, big screen TVs, the whole bit. So when things changed, when they had to pay that back, they realized they couldn't do it. And I think it did catch everybody unaware. So, as a result, there's tighter lending standards. So obviously, right after a crisis, the world capitulates and tightens up. And yes, when we had some of our properties we were trying to sell to legitimate buyers who were 700 plus FICO, 6-figure jobs, the whole bit, lenders weren't moving. You had a heck of a time actually trying to get a retail loan. I mean, obviously you'll know more than I on that, but that was difficult. So I think, then comes quantitative easing. So the point where everything stops and then the market goes, okay, we're doing nothing. Well, the Fed steps in and goes, well, now we have to sort of, stimulate the market. And their idea was quantitative easing. So comes lower interest rates, and then slowly but surely we have a little more flexibility in underwriting standards, et cetera. But, again, I'm not a mortgage dude, so I can't really comment too much on that. But I sort of look at, where we're today. Well, I look at, FHA is today's subprime. And when you take a look at the FHA statistics, the delinquency, for FHA is much higher than other loan segments. And, that's been a lot of stuff that's been written over the past few years. There have been FHA loans. So, for me, it's just packaging it differently. We're having low down payment, 3.5%, lower credit score, allowing high debt to income ratio to come through, making some exceptions. And, you're being encouraged to go forward and buy because you've got the real estate agents going, hey, if you don't buy now, next month it's going to go up 10 grand or 10%. You're going to miss out. So, I think there's a lot of contribution in what was happening over the past little bit on this side of the housing market, like the second part of the housing bubble here. So, I just look at it going, yeah, are there better underwriting standards? Yeah, there is, but there's still people getting through. And from what mortgage underwriters or brokers tell me down in my area, they're doing the majority of stuff they are doing was FHA over the past couple of years. So to me, I think that's really sort of helped. Again, you're not looking at, like, I look at it going, if you're putting 3.5% down, and we all know that you're not looking at equity or future appreciation. You're looking at how much can I afford in a monthly payment, and that's the trigger point, right? So if you can afford it, we're going to give it to you. You see?
Yeah. Got it. Another piece that, and again, this isn't I'm not bashing you or what. I'm just asking questions. I want to learn this because if we're on the brink of a big crash, I want my viewers to know that as well. But the one thing that kind of throws me off a little bit is we saw so much house appreciation in the last, let's just take 2 years. You see, like you were saying, and I watched your video from, I think it was yesterday, the day before, you had Blackstone, raising all this capital. But one piece of this puzzle is you saw even like in Tampa, down in a lot of sections of Florida, throughout the country, there's areas that are picking up, 20, 30% a year. And they have been over the last 2 years. So there's a ton of people out there with a ton of equity. So my question, I guess, is how are those people getting foreclosed on? Because if your house went up, 20% last year and 20% the year before, wouldn't there be enough cushion there to resolve a foreclosure issue? Why would those clients not just sell the house? Because my assumption, and this is my assumption, is they would have some value in that house or some, excess equity in that house to avoid a foreclosure.
Well, that's a pretty good question, Dan. And quite frankly, it's something that's been discussed quite often, in the news media and like the housing media on the internet, things like that. That's kind of always been the sort of, counter to housing bubble. It's like, hey, we have trillions of equity. We're at all-time high on home price appreciation. Just sell and walk away and everything will be good. So we don't have anything to worry about. So that's actually kind of we'll call it a misleading statement, because what really transpires is a lot different. So just because you have equity, okay, doesn't mean that you have cash flow. And the issue is that people are in a cash flow crunch. That's why they're not paying their mortgage. That's why they get into a default situation, fall behind, and eventually fall into a foreclosure process. So it's one of those things where, I have all this equity, but here's the deal. I have to sell. And I don't know if I can sell right now, and I'm hedging my bet. Maybe there'll be a change. There's a lot of psychology behind the scenes when you're facing foreclosure as to what to do. But it's almost like they fear what's going to happen. And also, the longer you don't pay your mortgage, it becomes a lifestyle thing. Yeah. And so you're not really saving the money, or you're spending it. Who knows? But the point though is that they're actually loath to move to sell, because now they actually have to, once they sell, they're going to now have to rent someplace, last month's rent, et cetera, et cetera. So it becomes somewhat problematic for them, and it's a little bit of a culture shock. But here's kind of the scene, and this is why, like 6 months ago, say January of this year or middle of last year, say you had the only foreclosure on the block, and you probably could sell, someone would buy your house, you probably could walk away with some money in your jeans, and you can move on and do something else. But the problem is that homeowners don't react, and they tend to either, number one, stay longer than they should. Two, they don't have anybody that can provide them with legitimate advice to help them through this situation. They talk to their bank or their lender, and that's not really, not giving them all the options or giving them, maybe a different perspective. Yeah. Three, a lot of people, because I talk to homeowners in this situation every week, multiple times a week, a lot of people still believe that there's some sort of moratorium or there's some sort of protection going on. They don't actually believe they're going to go to foreclosure. And those that are in the process think it's going to take years. So all those are kind of misleading positions or statements that they believe. And again, it's not, they're talking to armchair realtors, armchair attorneys, armchair, financial people, not people that are skilled and can actually answer the questions. So they're making these poor decisions. They're kind of stuck. But here's where they're going to get caught, because, as I said, 6 months ago, if you sold your home in January, you could have walked away most likely to be okay. But here's where we are today. Okay, remember, every month you don't pay your mortgage, you're chipping away at that equity. So that's number one. Number two, now we're in a situation where you're not the only person on the street. Now there's more people who are listing their homes, and more people who want to sell. And we have, as you said, the higher interest rates. That's hitting affordability. So this is where you get kind of caught, is that your equity is being chipped away every month, every year you're not paying. So that what you think you have is less. Now, what fair market value is being reduced based on price point, inventory, affordability. That's being compressed from the top end. And here's the scoop. If we all want to get our price point, our premium price point, then what do you need to do? You got to have curb appeal. You better have a new roof. You better have updated kitchen and bathrooms and stuff. Well, now that's great, but to me, that's the number one issue, is that if you have a cash flow crisis, that's why you're in the foreclosure process to begin with. You don't have the money to do all those things to get that premium or that real high good price on your property. Therefore, if a real buyer is coming in, they're going to go, okay, well, maybe you got it listed at fair market value like Mr. and Mrs. Smith down the street, but they have a new roof and they've got, quartz countertops or whatever they've got. You don't, and you can't afford to pay or do those things. So therefore, I'm going to offer you less, and so therefore your virtual equity that you thought you had via Zillow is kind of gone now. You see, and that's kind of where we're headed. And all these issues, and this is just issues right now with interest rates, inventory, stuff like that. We haven't even felt any of the foreclosure stuff that's coming. That's not even near market ready yet. That's going to further push things down.
Got it. So do you think, here's what I'm now seeing, what a lot of people are doing post forbearance. So you know what a forbearance is. So anybody out there watching, what a forbearance is back in right when the pandemic started, the government came in and said, well, your mortgage company, if you have a Fannie Mae or Freddie Mac loan, they have to give you what's called a forbearance. So basically it's you kick the can down the street on your mortgage payments. You're going to have to make them up somehow, some way at some point, but you can kind of kick the can. A lot of them went up to 20 months, almost 2 years that people didn't have to pay payments. That's another piece of this puzzle that, as I do analysis on all this stuff, I'm like, that could chip away dramatically at the equity in somebody's home. So you sit there, and I talked to hundreds of people so far that said, yeah, I took the forbearance because I was able to not have to make a mortgage payment. So they put their money in, some of them were prudent. They put their money in the savings or stocks, which ended up being bad, or Bitcoin, which ended up being bad. The whole world's starting to crash right now. But a lot of people didn't save that money. Like you just said, everybody went out and started spending and buying this and all this other stuff. Because they used to, in 2008, we always called, the housing market was just an ATM machine. People just use the house as their ATM. But the forbearances, as I do more studies on the forbearance stuff, let's assume you don't make a mortgage payment for 2 years. Well, you probably have, let's say, $1,000 a month in interest on that loan. That's $20,000 that's going to get kind of wiped out of your equity that fast. That might be another reason why, this is coming about on what we're seeing. But, so I wanted to talk to you about that. And then the other piece of the puzzle is, I'm starting to see, and we're all starting to see, a lot of realtors starting to drop the prices on values of homes, because now there's FOMO on the other side of the equation. The sellers are freaking out. Like you just said, January, you could have sold and got top dollar. Now every month goes down and the bidding wars are ending. So your top dollar is starting to come back down. So that's some part of the agenda that I'm looking at to say, where is all this going? So what do you anticipate? Like on my side of the equation, it's just a question, I guess. What do you consider a crash? Is there an X percentage that you're like, oh, if the market goes down 25 or 30%, that's a crash? Or what would be kind of your definition of a crash? There's no right or wrong answer. I'm just asking your opinion.
Yeah, I think anything greater than 20%, I'd have to say, would be in crash territory.
Okay.
Last housing crisis, some markets fared okay. Some took 50%, 40%, 60% hits. So I guess depends on, how exuberant it was, the exponential up and down extremes, right? So I,
Yeah.
I think that's, and again, the stuff I read today, he's saying 25%. I think if you look back at Case Shiller, and this is of course, the national index. I think from peak to valley, like from 2006 peak to 2012 or 11 trough was about, I think it was like 27, 28%. So kind of right in that realm there. And that was considered
Okay.
a crash. So I'm thinking if we're in that kind of range, 25 and above, we'd certainly be in crash territory. But here's the thing is, like, I mean, we're going through, I think right now, technically we're going through like pre-crash, which is correction. We're going to see some reductions overall, just from, just because of inventory, like things that, we can't really control, inventory coming on, and, interest rates rising. So you're going to have some adjustment to that. But the fun thing is we're not going to see how that takes place until after the summer selling season. So right now, I mean,
Yeah.
in Florida here we are, our school starts in 2 weeks here, right? So pretty much if you wanted to buy a home, you would have done that, moved in, you're moving end of this month type of thing. I know
Right.
up in the North Midwest, whatever, it's day after Labor Day. So we're going to see we'll start to see some things really take place, or see something in September and October. And then every month there's more and more foreclosures being filed, more stuff's happening. So I just think that it's almost like we're going to see a few waves of this. It's going to be attorneys, like I literally have spoken to attorneys from that represent the plaintiff, like the banks and lenders. And you've got, they're being notified by the banks and lenders now saying, guys, how's your staffing? You're ready for this, because, we're going to start sending you guys, 200 to 300 of these filings, a week. And, and they're saying that this is going to go on for 3 to 4 years minimum. So and for me, as I mentioned earlier, it's not just one thing, it's a multitude of things for me to go, yeah, we're having a housing bubble bursting, and it's going to be a crash situation. And don't forget too, what I don't think really many people picked up on, a few weeks ago, Jerome Powell at the Fed, he basically said that the Fed has to reset the housing market.
Mm-hmm.
Okay, so
you and I would pay attention to that. Most
yes.
people just watching it just hears the rate piece of it. But yeah, I heard that.
Yeah. So what to me, when he says reset, that basically means, that's the nice, polite way of saying we're going to crash the market, because prices have to come back down to reality, so that the average buyer, the first time home buyer, the people that, we need to have price points more in line with income, right? Median price points and median income.
Got it. There was something I wanted to go over, but let's do this. Let's open up the floodgates here, because I'm hoping I'm hoping there's a decent amount of questions for you on here.
Sure.
So but here, let me ask you one more question before we get to those. So you did a video, I think it was yesterday or the day before, on Blackstone.
Yeah.
They're just hoarding all this money. They're trying to accumulate all this money to then jump into the market. If you're out there, and this is what I get every day, the first question here is, where are we going to be Q1, Q2 of 2023? That's a lot of the questions that I get. When do you think they will start? Because they're a heck of a lot smarter than you and I. When do you think they'll start gradually moving into the market to buy more aggressively? Or are they buying periodically, just accumulation, like dollar cost averaging? Or are they setting up for a massive correction? And did they have a time frame on when they think that might happen?
I don't really have any contacts at Blackstone, so I don't
Okay.
know some of that sort of behind the scene information. But I do have other investor guys I work with that are, of course, not Blackstone 50 billion, but they're pretty darn successful. And just FYI, big thunderstorm world.
I just heard it. I was like,
So,
it's sunny here.
so in case suddenly power goes and I fall
Yeah.
off, that's the reason why, right?
No problem.
It's almost like
I
it's nighttime
appreciate you
outside.
joining us today. I really do.
So it's kind of funny. But so with the Blackstone thing, here's the deal. They look at things like they're different than you and I. Okay.
Yeah.
And the reason being because they know that it's, number one, not their money. Number two, the return that they have to bring back to their investors may not have to be double-digit cash on cash like a small investor might need to have on an annual basis. And it's a 20, 30-year play. You know what I mean? But the COO of Blackstone came out and said, for them, the segments that are the most profitable are rental market and logistics. Okay, so things like warehouse and things like that, where they can buy massive storage space and be help the transport, logistics, stuff like that. That's big for them, and also single family asset rental. And what the unique thing about this housing market is that last time we had price points that went up, but rents didn't go up too much. This time it's almost like a double whammy. We've had huge home price appreciation, and rents have also had the past year massive appreciation as well too. So if you're looking for shelter, you can't buy because it's too expensive, or you choose not to. Well, then I'm going to rent. Well, either you're going to continue to rent and your landlord is going to raise your rent, or rents are still going to go up, and they'll top out after a while. So the Blackstones of the world, they're basically going, we can buy now. So they're already buying at the auction. So they've never really stopped that. They're going to pick and choose what's out there, and yeah, they got a ton of money. But here's the thing too, that's a big buyer. There's actually more sophisticated buyers that are out there that we don't even know about, because I've seen some. So I know a few of them, and I'll give you an example. These are small equity funds, and small being maybe 100 million, 200 million equity funds, created by tech people out of Silicon Valley, and they're using all sorts of their tools and AI to basically drill down to the street level to tell them, based on hundreds of different I guess pieces of data points, to say which is the best home we should buy at the auction. So so it's not just the Blackstones of the world; it's everybody that's looking at this. You see, and
I didn't mean to.
It's to say so that's why they're already starting now, and it's going to be very competitive once it starts. The floodgates open.
So based on that, though, if you sit on the sidelines, continue to sit on the sidelines, you have all these investors coming in. They backload the data saying we need a 15% ROI. So here's where we're going to need to put those rents. Doesn't over time, my fear would be my rent's going to go up 10% a year every year for the next 2, 3, 4 years. Mm-hmm. If I bought a house, and I always preach this, if you're going to buy a house, I want you in there at least 3 years, maybe 5. We don't know what tomorrow's going to bring, because even if you bought in a decent market for 3 years, you probably wouldn't make a ton of money. But in this market, I look back and say, well, okay, in 5 years, if I bought now and we had a 20% correction, over the next 2 years, and then every year we go back to the normal 3, 4, 5% appreciation, within 5 years, would I be equal to what I paid today? Versus, and again, this is my thinking. If I rent and my rent payment goes up 10% or 8% a year for the next 3, 4, 5 years, would I have not been better off buying? So that's where I struggle, and that's where I think most people struggle. They're saying, okay, the housing market's going to drop, but on my side of the equation, at least I know what I know on my housing payment, what my housing payment's going to be, versus rents going to be all over the map, and you can't, rents. I don't see in the foreseeable future, especially because of Blackstone and all those big investors coming in, I don't see the rents going down anytime soon. So, it's like a double-edged sword. It's like, what do you do? And I'm trying to answer questions for people, and I don't even really know what to tell them.
Yeah, that's a tough nut to crack, just for that reason. I mean, remember, like the Blackstones and the big funds, the REITs, any big investor, if they're buying at the auction or they're buying off market, they're buying at a discount. So you have to realize that they've got cushion already built in. They're not spending. They're not in bidding wars for their properties. Okay, so they're going to be buying discount anyway. So they're already in a better situation. And yeah, they're going to ride this wave of appreciation and of rental appreciation. That's what they're going to do. So they know they've built in cushions, and realize that they can always refi them afterwards to larger money groups, and they can always sell too. So I think they're in a position where because they can do things on such a grand scale, they're getting the best rates, they're getting the best deals, they're getting the best price points. They can move stuff, and they're not selling one property; they're selling millions of dollars of pools of property. So they're pretty nimble. And like just before, like part of, say, a Blackstone, for example, is part of their, I guess a growth or acquisition of money is they, every so often, they do cull the herd. They go through their properties and they say, okay, let's take the top 10% of or the worst 10% performing assets, and let's sell them to other hedge funds or other investor buyers, you see. So they're not just sitting on these properties and looking at good and bad. They're pretty active in making sure that they're lean and they know what they're doing.
Got it. Okay. That's all I got for you. So let's do this. Let's open up some of the floodgates and figure out where we're going with this thing. So I don't know how many questions are here. I answered the first one. It was more of a financial one. We got somebody in Miami. They might be down in your neck of the woods. I have a place on the east side of the Florida coast. I have a place in Cocoa Beach. Oh, cool. And I was down there in the 2000s. I was flipping and fixing and doing stuff down there. Yeah. And I got one on the beach that I kept. And I thought, oh, good value, good this. I had to fire sale that thing in like 2009 because the renters weren't paying me. I mean, it was it was a world events going on. Finally, I had to sell it, and I lost. I even bought it. I bought it in like prior to 2000. I sold it at a $120,000 loss.
Holy cow!
During the pandemic, because I'm in the mortgage business, and we were just saying at that time there was still everybody and their mother wanted mortgages. But there was no lenders out there giving mortgages. So it was just like, that's when everything the demand for mortgages was huge, and there was just there's no outlets for it.
You couldn't get it.
Yeah. I ran into the same thing. We got somebody in Springfield. Thank you so much for joining us. Let's go through here. Let's see what we got here. I think part of the bubble of job growth I think part of what is a bubble of job growth pay versus increase in value of housing. That was a comment. So if you guys would do me a favor, before you post a question, put a Q in front of it so I know it's a question, not a comment. And also let us know where you're coming from. We got Tinley Park. Michelle, you're in my neck of the woods. I'm in Naperville, Illinois. The next thing is hello from Houston. Sorry about this. I was trying to get to some of these questions. Okay. By the way, don't see a crash, but maybe a softening by 10 or 20%. You want to address that or just keep moving on?
Well, you know what? Again, I think it's all, there really is no definition of a crash. I think that's all personal. I mean, I look at it going, I could spend 5 hours telling you guys why I think it's going to crash and all the data points that go along with it. Put it this way, you believe it or not. I mean, that's right. I don't get upset about that. To me, I just look at it as opportunity, and you can sit on the sidelines and watch it go by. Or you can participate somehow, some way, and make the most of it, because there will be price adjustments. And what did they call? I mean, there was the Great Depression back in the 20s. Now the 2008 was called the Great Recession. So what are they going to call this now?
Bubble 2.0.
But housing bubble 2.0, and they're talking about recession 2.0 here, right? So. I look at it going, it's not just housing, it's everything. But I think housing is almost like the last holdout. Housing gets affected almost like last of all the things. You know what I mean? So
yeah, got it. Okay, so that's one of the things I think everybody's terminology too of what a crash is, because my terminology of a crash, I'm thinking it's Armageddon. I'm thinking 50% or more, in the market. So it's all relative to what you're thinking as well. Sure. So again, there's no right or wrong to it. I just wanted your opinion on some of these. That's why I asked John here, and I said, I promise you, I'll have no gotcha moments or whatever. I want to know the facts behind everything, and that's the reason why I do my channel. What will mortgage rates be for real estate investors for the short and long term? Randy, you might be able to answer. Well, here, let me preference this by one question, and then we'll get to Nello. Randy, because you see what Blackstone's doing and everybody else, if you're an investor out there, would you be leveraging some of because your property values are all the way up here now. Mm-hmm. Would you be leveraging those properties and pulling out some cash to be ready, like Blackstone, for, maybe it might be 6 months, maybe be 12 months, maybe be 18 months from now, but you have that money on the side so you can actually go in as a cash buyer, make your presentation look as peachy as possible, go in there and buy that property. You can always do delayed financing after the fact, but would you be a proponent of pulling out your some equity in some of these houses now, just to, put that little bit of dry gunpowder in the case there, ready for this market to stumble?
Yeah, I mean, if you can, after you refi or pull the money out, if it still makes sense from a cash flow perspective, by all means. I mean, I know people who are doing that right now, because, like people either pulling money out, or I've had other investors I know saying, I'm selling everything I can because the numbers are so silly that, I'd be foolish not to, even though it might be cash flowing. The numbers are so good to sell that I'm just going to cash right out and not deal with the headaches anymore.
You're in Vegas, you're out, you know?
Yeah.
So I'll answer this question. Well, I guess I'll ask you this question. I don't know if you're dialed in on interest rates and so forth. Do you see rates getting completely out of hand on your side of the equation? You've been doing this a long time. Where do you see rates, in this environment for the next maybe 6 to 12 months?
Well, I think we got to follow what the Fed has said. And this is a pretty safe answer, but I think the Fed, when they see the damage in the marketplace and when they see it's getting reset, then they'll start to pull back and we'll move back to their quantitative easing. So everyone's kind of predicting that we'll find out the next couple of days what they're going to do, right? End of the week, and then it's tomorrow. Yeah, today's Wednesday, right? Yeah, or today's Tuesday. So what day is it today?
Yeah, it's Tuesday.
Tuesday. Okay.
I didn't mean to stump you. Yeah, it's
I'm
tomorrow.
Like, geez. Yeah.
Well, I'm interested to see what I know we basically know what they're going to say this time.
Yeah.
I wonder what their future guidance is. But also, I do videos every day. Here's the weird thing. We had the Federal Reserve last 6 weeks ago come in and they raised the federal funds rate 0.75%.
Yeah.
Mortgage rates are down 0.75% since then. That's why the market is just weird. I guess that's not a technical term, but I've done this a long time. I've never seen rates and the volatility and everything as much as it is today. I mean, we'll have one particular day where rates will go up, 0.3% in one day. I mean, that's scary. So my concern is what the Fed's outlook is and what they come back and say for the future guidance, because it could be kind of catastrophic on all the markets, stock market, interest rates, housing, and everything. So that's where I'm gonna do a live event tomorrow, kind of just showing what they're saying and kind of interpreting it for everybody to watch. But how do you think rates are going to get way out of whack, or do you think there's a threshold where it'll go up to, and then at that point, housing will fall off a cliff, so nobody could really afford to go much higher?
I think that's the latter is probably what's going to happen. I think they know they must know the sort of breaking point, and I'm sure that they're sort of easing into it at this point in time. I mean, I think it was what Goldman Sachs said, or Moody's, like people are predicting how many more rate increases we'll see before the end of the year, and that was really kind of what they were saying with that reset comment. They were saying we're going to raise till the end of the year, and we'll see where things are at, which to me means they'll pause. And if we see that 2023 starts off with housing falling down, then they'll know that they'll plateau, and then as it falls, they can slowly kind of drop rates, etc. So I think they're probably trying to position it for a soft landing, so to speak, as opposed to something hard. And that's the problem, though, is like so many other things in the economy are out of control that I don't think we can really have a soft landing.
Got it. I look at ADP or Moody's data, kind of like I look at the ADP payroll numbers. They're always wrong. I gotta say it that way. Moody's, I still can't. I don't understand why nobody from Moody's rating agencies, nobody went to jail back over the subprime stuff. That's a whole different animal to cover. But it's like they stamp these things with A-rated, bond ratings, AAA, when they were just junk. And that's for another time.
Yeah, that's watching The Big Short over again, right?
Yeah,
so
exactly. Yep. And it's like people, I don't know. It's like people know, you kind of think, and on Wall Street and all that, these guys are playing with billions of dollars. They're no dummies. Yeah. We got San Antonio, Texas, Randy Patrick. Okay. Joshua. Randy
Josh.
Patrick knows what's happening.
I know Josh, yeah.
Josh, me and Josh go at it every day on YouTube. Wait until the Fed actually reduces its balance sheet. It's charade with QE. And Josh, I don't mean any disrespect, buddy. And I try on my videos not to pump the FOMO. I'm just trying to, I'm trying to revamp my channel. I don't want to get into debates on what the housing market's going to do, what real estate's going to do. My whole goal, what I set out for on the channel, was to educate those on the financing piece of the puzzle. So if you're looking to buy, you can be buying an investment property, a single family home, or whatever. It's how you do that, how you structure, what timing you do to grab a rate or whatever. But I still feel that if you're going to buy a house, it's a personal decision. It's a financial decision. It's like having children. When are you going to be ready to have children? Will you ever be ready to have children? It's to rent or buy or just stay on the sidelines for now. You know, it's like, you want to have kids, don't have kids, or let's just wait a couple years. And there's no right or wrong answer. So, Josh, I apologize. I come across to you that I'm just pumping FOMO. I've done this for 33 years. My true goal is just to educate those out there. If they're looking for financing, I would love to be able to help them, at least guide them down a path, because there's so many BS lenders out there as well that just tell you what they want to hear and move on. We got somebody that says false. I don't get that one because we didn't really ask that question. We got a question here. So, does the Fed attempting to change the definition on what a recession have any impact on the consumer psyche? Or if so, what outcomes are possible? Go ahead and take that one if you don't mind.
That's interesting. Again, I think, as we know, housing has been under such a huge narrative for the past couple of years. All right. And I can tell you that, just before COVID, we were bubbling up. We were seeing an increase in foreclosure filings. Other guys that I talk to and deal with that are large buyers, they were going, hey, we're going to be right at housing bubble 2.0 now. And we've got this reprieve for the past couple of years. So,
yeah.
I think everything, as we know, and we don't have to get political, but just the point where it's almost like everything in the world has a narrative, and anybody can try to spin it any way we want. So I look at it going, just for me, I go back down to the facts, the numbers. The neat thing, if you really take a look at what we have going for us, is no one has a crystal ball, right? That's clear. If we had a crystal ball, we wouldn't be talking. We'd all be on a beach in the Maldives or something like that, in our $500,000 little states, or in jail, who knows, right? But true. But the cool thing though is that we have the time machine. You see, so I can go back in time the past 10, 12 years, and I can go, what happened here, 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 here? That's what I trigger. I go, okay, well, this is how things played out. So for me, I'm armed and educated with what to look for to see how it plays out. And now it's actually playing out. That's the fun part. So, people can, the narrative can deny for so long and spin for so long, but at some point in time, like I think what you'll see now is that there was more no's, a year ago. Now there's more yeses. So the needle has swung, on this side now that, hey, we're having, I don't think it's, what's what I'm looking for. People agree there's a housing bubble, there's a bust, whatever. What people don't like to do is actually go on record to say, we're going to crash at 30% of housing values. Like, no one wants to be the one to say that, I guess. But as I said today, we had that guy. It's actually it was a Business Insider article, and some economists said that's the guy. Like, I'm going to launch my next video once we're done here, and I already recorded today, and I'm talking about that article. And he basically said 25%, is what he's banking on, and that's kind of an estimate. That's probably a light estimate, of a decrease in market value. So.
No, I get it. And that's why I had you on the channel. I want everybody on the channel. I want people, it'd be like, if you're on that side of the fence or this side of the fence, I just want people to post the facts and what their thinking is and what their data is to validate some of the information. The one that drives me nuts is, well, the housing is the prices have ran up so high, it's got to crash. And I'm like, common sense kind of, yeah. But what data do you have? So that's why I love watching your stuff and reaching out to you. That's why I'm having you on the channel, is because I don't want this just pumping real estate. Yeah. I want, here's the facts, guys. You guys choose on what you want to do. We're here to facilitate it. If you're looking to buy a house, there's one side of the equation. If you're looking to financing, I would love to help you. So, but thanks for answering that question. Let's go to the next one. If you have to go anytime soon, because I know you got a busy day. I didn't know. Many times on a Tuesday, I don't know if I'm going to get 50 people or 300 people. So what about the supply demand? We are still way short compared. That makes a difference in how houses are priced. Low supply, higher prices. Go ahead and take that one. That's right in your wheelhouse.
Yep. Well, yeah, it is supply and demand. And I would answer that. If I answered that 6 months ago, I would say that's why we're having high home price appreciation, double digits. But guess what? We're 3 months short. Okay. So the most recent stuff that came out by NAR, National Association of Realtors, said our sort of existing home, and I'm going to say this is existing homes, not builder, because builder today, builder inventory is 9.3 months. Okay. 6 months is a balanced market, according to all the real estate pundits out there. According to NAR, this past month, we were at 2.9 months of inventory. So we're almost to a balanced market. I mean, obviously the amount of new homes there's not enough volume to bring that to sort of blend it to get us to 6 months, but if we're at almost 3 months now, and we haven't even, we're going to see more coming and more stuff going on, because now we're seeing the effect of higher interest rates. So I have no no concern that we're not going to see an increase in inventory out there. And with an increased inventory, now what do you have? You have a shifting from a seller's market to a buyer's market, which means sellers now have to compete. And if you're a seller, you can't sit there with be the highest price and not budge, because the buying power of potential home buyers has been greatly diminished. I mean, Dan, you can answer. How much percentage on how much more mortgage costs now? Like it's
a lot. A
exactly.
Lot. And the average, I remember when I started doing this years ago, the average loan was 80 grand. Then it went to 120. Then it went to 180. Now our average loan, I think, is like 380. Which is double where we were 5 years ago on my side of the equation. So you have a lot more, but I'm also doing a lot more pieces of the country. I'm now federally chartered. So years ago, I wasn't doing California and Arizona and Florida and things like that. Now those floodgates are opening, and it's astonishing how the house values are so much, are running so high. I'm in Illinois. We don't have that, what they call that, what's that word? Appreciation. I bought my house 20 years ago. It's worth a little bit more than where it was 20 years ago. It's crazy here. Then I'll see people in Florida and Arizona and California. They'll buy the house, and then even in a normal market, 2 years goes by and they're up 20%. It's like, dang, gone. Why did I live here? But whatever. You pick your poison.
Exactly.
All right, low supply, high prices. So let's go to the next one. So thank you for answering that. The next one, everybody is about to go Volcker. Quickest way to draw money out of the system is go after unrealized gains without impacting day-to-day standard living. You get that one? I don't.
I'm not too sure what he means by Volcker, or is he talking Voldemort for Harry Potter? I don't know.
We'll go to the next one. Where do you see rents going? That's from Dennis O'Brien. He's a friend of mine out in California. He's a realtor.
Cool. Rents should still increase rents tag along and drag along with home price. They tag and drag along. So obviously home price appreciation has gone up, and it's kind of plateaued now, and we're starting to slide. Rents the past year made the biggest increases. I mean, if you start taking a look at what states or what metro locations had massive rent increases, you can take a look at that, whether it's single family, multi-apartment, whatever. So expectations are we're still going to see the rent increasing, because it doesn't happen overnight. Like, in other words, people who couldn't buy, today are going to jump into a lease agreement, and they're good for at least a year. So, the one thing about house pricing, I think it's a little more volatile, or can move on a quicker pace as opposed to rent, because rent, you're locked in for leases, right? 12-month lease. So I think that's why rents will eventually come down. But I think we still got 1 or 2 years of rent increases at minimum.
Is it common that rents? I don't follow the rental market much at all. You probably do. Do you see the volatility in rent payments as much as you see in the housing piece of things now? Do you understand my question? Like, even in 2008, 9, and what's that?
People being current on rent payments?
No, I mean just the prices going up. So, for example, back in, and I should have done a study of this, back in like 2006, 7, 8, rents. Then when the market just crashed, did rentals go down as well? How much you pay in rent? Like in 2012, was it much less than 2008, because that was the peak of the bubble? My question makes sense.
Yeah, I know what you're saying. I didn't really follow that, to be honest with you. I think, and I realized too, the big hedge funds didn't come into play until 2000, sort of a late 10, 11, 12, and 13 going up. So I think, that's where we became a little more aware of the rental market, because you suddenly had such a huge groups with big money coming in, and what really was wealth transfer, right? You lost your home, they got it at the auction, or they bought it as non-performing asset, from the lender, and now they're renting to you. You see, so I think the whole idea at the time, there was such financial carnage that I think rents were reasonable, and they bought at such cheap prices too. So I think they had their plan as to how they're going to take rents up, on an annual basis.
Got it. Makes sense.
But now, but now things are like, if you again, my son who was living in Sarasota, I mean, he left his place, he split up with his girlfriend. they would have gone from like 1,400 to like 1,690 or something with an annual increase. Well, guess what? When they left, and then that unit was up for like 2,200, to rent. So, any vacancy, and that's like a multi-family apartment type complex. Anybody who's a landlord if there's a vacancy, they're going to go. We can always ask, as much as we want, and then if we have to pull back, we'll pull back, right? So, same concept,
Got it. All right. This one might be for me, maybe. Rate lock for 1 year. Builder just reduced price by 30 grand. Do you think I can renegotiate with them or not? If I walk away, they will still sell the house for the current price and not what I signed for. Do you deal with a lot of, or have you dealt in the past with new construction? Because this is kind of a new territory to me. I've never seen this many people building homes ever. And the builders' contracts are so bad. I mean, so bad. They read, and I say this on every one of my videos, it could take us 2 years to build this. If the material prices go up, we're going to pass it on to you. This, that. You have to use our preferred lender. You have to do this. You have to do that. Now, I think the pendulum is going to swing way to the other side of the equation, that now the buyers are going to say, let me look at this. Wait, you're giving me a credit, but I have to use your lender that you own. There's a lot of nuances there I just don't like. But in his situation, if you were his realtor or his advisor on this, would you walk away? Because the builders starting to negotiate yet? In his situation, he's probably contracted. They can say, you're under contract.
Yeah, they could, but there's always an out clause. Somehow, some way you can find that out. But I guess it boils down to, what did he put down? What did you put down as escrow or sort of earnest money deposit to hold that property or to have them build that? I guess you have to take a look at, is it better for you to walk away? I would go to them clearly. I would go, okay, reduce, upgrade, whatever you can do to make that happen. But I think. But don't forget, there comes a point where if interest rates go up, and then like say you were offering him that mortgage, you have to requalify him at the end. Maybe they don't qualify anymore, right?
Right.
So so people are out, and again, we're seeing that builder new home inventory increasing. It just hit a record 9.3 months. So that's gone up, and we're hearing, because it's out there in the news today that like for example, Pulte Q2 had 15% cancellation rate, and the year before was 7%. This time same year, like a year ago. Yeah. So they're starting to feel that, and I think there comes a point in time when if we jumped in and took them a year to build a house, and we were at 3 or 3.5, whatever, we could afford it. Now if we're at 6 and change, numbers don't make sense. I didn't, my business or my income didn't jump that much over the year, so I can't afford that payment anymore.
Right.
So
got it. So hopefully that answered your question on that one. Let's see. The next one. Let's see. We need more inventory to normalize the market. About how much inventory do you think we need for the prices to go down at least 10%? How much inventory do you need to go down 20%?
Well, I think that's a bit of a loaded question. Again, going back to my previous statement where, the real estate sort of pundits have always stated that when we have a 6 months worth of inventory, that we should be in a normalized market. And there's an equal number of buyers, equal number of sellers. So there shouldn't be, everything's in balance, right? So I guess to get to that, to get to that balance of market, we'd probably, I'd say, almost like crash territory. I think, what's it going to take to get us to the balance? Maybe it's a 10% price point. Maybe it's 15% to get more inventory to come on. People want to sell. They want to cash it before it drops. And then after that, who knows what's going to happen. So, again, I don't look at, I just look at months. Like real estate's done in time. Like, it's not like how many properties, it's how much time to clear out inventory. So I think we're halfway there. We're at almost three months with inventory now on the existing home side. So if we can get to 4 to 5, I think we'll start to see some damage going on.
And a lot of this is also regionalized. Like I had a young lady from Boise, Idaho here a couple weeks ago. Their market's getting hammered now, but they're basically, their values went up like this. I mean, at some point, there's got to be, you can't afford it anymore at all. So you either got to move out of there or do something. And we know all the big companies are going in there buying up the real estate. So it even makes it hard to rent. So that's the scary part of a lot of this stuff. Dude, I'll just take it off the chart. Josh, let's just agree to disagree. How about that? During a recession, rents will go down. What's your comment on that?
Not right away. Not right away.
Got it.
Okay, because you're in a lease, and you know, and here's what, you know, future foreclosures mean future renters. So you see, when you have a housing crash or you have a correction and more of those people are losing their homes, they're going out into the rental community. So the rental market will actually have a surge of people, and we could still have some rental accommodation supply issues, etc. So you know what I mean? It's just, again, it always goes back to the wealth transfer, of course, but you know, rent takes a longer time to follow the price point of you know, from home price appreciation. So it drags along. So
cool. We'll answer a couple more and then I'll get you out of here, because I try to do these for an hour, but if they go over, I do that. Those folks who chose forbearance, did they really get to just take a break from paying or and extend the loan 20 months, or did those missed charges get added to future payments? Michelle, what I'm hearing, are you hearing anything on your side of the equation on those that were in forbearance? What's the most common theme you're hearing as their result?
I didn't realize I'd have to come up with my 20 months of payments right now. Okay.
I am, if they go into bad default with their lender, I am getting some people coming back saying, you know, they modified my loan. Well, back in 2008 or 10, if they modified your loan, wow, they would increase your rate, extend the term out to 40, 50 years and do it from there. I have seen some modifications come back that are pretty good termed, you know, 2.9% rate. They just rewrite it as a 30-year mortgage and go with it. Some people have it added to the end of their loan, free interest, but the majority of them are probably, as I advised and Randy just said, is, you know, you don't be surprised if you get a statement from your mortgage lender saying, hey, you guys owe us $10,000 or $15,000, because that can happen. So
that's become more prevalent now. And again, I think there's two things that were happening here. Number one, it just was education or misinformation, because when you know, the forbearance was announced, it was kind of like, hey, we're doing this. It's a government thing, but it really kind of wasn't. It was up to the policies are individual based on, as you know, each lender. And it just wasn't explained right. You could just simply, people were being put in forbearance who didn't ask for it. People would go online and click and be in forbearance. Like it's almost like the last housing crisis when, you know, people were trying to get loan mods. They faxed documents in. People, you know, lenders could never find it. Like, so we're in that same crap again, which I hate to laugh, but it's silly. And you know, the problem with loan, so all these people, when they get that sticker shock, they're going to go, what's the deal? Then they're going to go into, and this is how the statistics are played too. So, you know, Black Knight Financial and other people are going to say, ooh, look, our forbearance numbers are looking real good. Yeah, because you can exit out of a forbearance program. That's a pay count. You're in it or you're not. Your 18 months expires. I'm not in forbearance. So guess what? Now I'm now in my loss mitigation area. And I'm going to do a loan mod. Okay, I do a loan mod. I may or may not get approved for a loan mod or a workout plan, so then I could fall into the foreclosure bucket. Or also I might do 1 or 2 months of loan mod, you know, and then I still can't make the payments, so I fall back out. Because I mean, you know this as well too. So a large percentage of people that are in loan modifications end up redefaulting within 6 months, if not earlier. You see, so it's, to me, it's the problem has already started with the forbearance. And all the forbearance has done is given them a reprieve during the pandemic, which obviously had its merits, clearly. I'm not saying that's a bad thing, but the problem, though, is that was never explained properly. And it's kind of like, we'll deal with this later. Well, now it's later, you see. Yeah. And a lot of these people, this will be your second wave of foreclosures. The people that can't get through and get themselves, you know, right on track, you know, with pain.
Well, I knew a lot of this was coming back a year or two ago, because when they came out with the forbearance piece of the puzzle, the first thing I'm thinking, I wanted to find the qualifications for it. So I even called my lender, and they're like, well, you just, if you just say that you're affected by COVID, we will click into that program. So then I'm like, okay, that's happening. And then we have, so now people don't have a housing payment. Okay. And then there was rent forbearance. So now people don't have a rent payment. And then you had the flush of money from the government just flooding people with money. And as we know, as we look at history and we look at the charts back to that time, consumer disposable income in 2021 was the highest level ever in history.
Yes.
So you didn't have a house payment, you didn't have a student loan payment, you didn't have a rent payment if you didn't have that. And a lot of people made more money during the pandemic than they would normally make. So yeah, the Fed did a big piece of this by basically dropping rates to zero, but you also have to say all this other stuff contributed to this. And now we're paying the price of all those actions that we're taking. Some were necessary, I think, but I think a lot of it wasn't. And that's my basically backdrop on a lot of this. What's your opinion? We'll conclude it at that. I just want your thoughts
Sure.
on, do you think that played a role? Because everybody keeps pointing their finger at the Fed. Nobody ever looks and says, well, the government pumped out, trillions and trillions and trillions of dollars to people. And we're finding out a lot of people didn't need it. There was so much fraud in the system with the PPP and everything else and we're all paying for it. We're all paying for it. So what's your back take on that? And then we'll leave it at that.
Okay. Yeah, I totally agree with that. I think that is a big contributing factor. So as I said, it gives people had a sense of relief for a period of time. And again, we don't like to face as a society, like, the stuff that when it hits the fan. So it's kind of like you had a little reprieve for a period of time. Now it's time to pay up. And I don't, either people thought, oh, I would just sell, or I'd get even more appreciation. Like, we don't know. But it hurt a lot of people. So a lot of homeowners didn't understand it, and they certainly took advantage of it. And now or their financials didn't change to increase or improve. I know primarily the small investor, the mom and pop investor market that had rental properties, that they took it on the chin pretty well. To make matters worse, there was this billions of dollars of what we call like rental. Like apparently they could get their hands on rent, like, whatever the top ups were, whatever was missed, but there were so many qualifications on that. People still had to be in the property. The renters, had to help, fill out forms and sign. What happens if, somebody didn't pay you for 16 months and they took off? You can't recover that money. So there's a lot of carnage that was done there. I don't want to go into sort of the conspiracy stuff, but I think this was a little bit of a dry run to see how we'd all react and to see what damage was done. Because in the end, I look at it, for me, all this is another layer of wealth transfer. When I look back at housing bubble one, what did I take away from it personally was, number one, the hedge funds are here to stay. And Wall Street has money, and the government likes that because it's cleaner, and they can't blame. It's not, policies or people, it's Wall Street, you see, and simple as that. And I also learned on housing policy, the fact that when you start digging into stuff, it's all about who knows who, and it's all about the dollar. So, we're just kind of, cogs in the wheel. So, that's all been kind of set up for us, and we're doing this again. That's why when I say housing bubble 2.0, I'm like, it's happening again. The same stuff's happening again. People better realize what's going on. But we have this information, as I mentioned earlier. Now we know what happened last time. We can look at it. It's like a book. Let's position ourselves. You can't fight the power. Okay, like,
right.
You're not going to fight Wall Street. You're not going to fight the Fed on some of these things. But if you realize how they're manipulating the marketplace and how it's working, that's where you can figure out what schemes can we go through, how can we beat them at this, what they do, what they won't do. So that's why I'm pretty confident going forward as to where we're going to have a crash. It's going to be a little bit of a managed crash, but for those who want to understand it and participate, get in the game now and learn this stuff, because we have a good 3 to 4 or 5 years of this kind of as again a resetting of the housing market. And I didn't create that term. That was, our friends of the Fed who said the housing market needs to be reset. And when the government is telling us that up front, you need to listen to it,
Absolutely. And if Randy's telling you from housing 2.0, housing crash 2.0, that housing bubble 2.0, my apologies there, buddy. If he's telling you, and that's why I had you on my show. It wasn't like I said, it wasn't to pump FOMO. It wasn't to get a gotcha moment. I just want your thinking, because I do watch your videos. I truly do. I want to know all aspects of this. I also watch CNN and Fox News to figure out where the heck is the middle. You know what I mean? So that's why I do a lot of this stuff. So it was a pleasure having you on the show. Hopefully we can do it again. And I told you I wouldn't get a gotcha moment. That's not my agenda here. I just want the truth and nothing but the truth, man.
Well, I appreciate that, Dan. I mean, obviously you got a good channel. You got a great business after you said 30 some odd years in the mortgage business. That's pretty, you know, got to commend yourself for being that long, having that longevity. You know, obviously you know what you're doing and you're serving your clients well. So, and you know what, maybe we'll do business here in Florida. If you said you could loan in Florida, right?
Yes, sir. I'm all over the country now. All over the country. Awesome. And what happened was, as I was trying to get licensed in every state, and it's difficult and it's time consuming and very expensive. So I joined a bank, who now I'm a broker through a bank. So I'm now federally chartered to help anybody in the country. Oh, cool. So that's what I do. So Randy, I greatly appreciate you having on here. Hopefully we can do it another time. And hopefully we'll have some open dialogue that we can discuss this in the future. All right, man. All right. Thanks for having me. Thanks for having you. Take care. I'll see you guys next time. Bye-bye.
Thanks a lot.
See ya. Bye-bye.